Alright guys, welcome back. Let's have a look at SPY S&P 500 ETF. So today it's pretty much flat overnight. Yes, we did gap down and we tried to fill the gap. We did fill the gap. We tried to go even higher, but closed I think pretty decent. And this level that we are going to trade with, so I'm going to be watching basically 377 from back December, where we were basically going back and forth. That's very choppy zone where a lot of people were, after this especially big flush down, a lot of people were chopped up, and then we went higher. So this week is OPEX, pretty big option expiration March 17th. So and in that like we have four more days left, so Monday is over officially. So to the upside we have 393. I'm looking at SPY, so this is 200-day moving average, this red line. So anytime you see any stock below 200-day moving average, you gotta stay bearish to neutral, because it's not an uptrend. It's not, I mean, it does look very ultra short term in a downtrend, but when volatility is high, it's pretty difficult to make money unless you just trade shares up and down. But if you are someone who is trading options, I mean, premiums are very expensive, and you will be having gap ups and gap downs when market is uncertain. And 22nd of March, we have Fed meeting, which is FOMC rate decision. Is it going to be 0? Is it going to be 0.5, 0.2? Because at the moment, market is pricing in 0.5% rate hike. But if there's no rate hike, well, we'll see. Market, in any whatever decision they make, market will react to it and it will be volatile. Doesn't matter. 0.5, 0.2, or no rate hike, market will go crazy in any scenario. Okay, so but until then, this week I'm watching this range, and also I wanted to show what I usually show here, which is internals for S&P 500. I look at the percent of the stocks in S&P 500 above their certain major moving averages, usually like 50-day moving average and 200-day moving average. So only 38% of the stocks above their 200-day moving average, and it's downtrending. You can see, we don't have to go into the chart, but you get the point. Like when percent of stocks get crazy low, so I'll go back to that March level and show you that 20-day percent of stocks that were above their 20-day moving average, the bottom was basically somewhere around this level, like 10% of the stocks were below. And even though here's the thing, so I want to show you this. So just pay attention to December, right? This is the graph of percents. So we have percents here, percent of the stocks in S&P 500. Today, 9.5% stocks were above their 20-day moving average. And pay attention to December. Even though price of the S&P 500 didn't move and it just stayed in a choppy zone, this divergence gave you a signal that, okay, like percent of stock, even though overall indices are not moving much, percent of stocks that are above their 20-day moving average going higher. So that was a good sign to go long. So until we see something like this, I'm not long biased, or until we see really percent of stocks go really low, maybe like 2-3%, and then maybe play counter trade. But again, I'm not trying to generate you ideas here, but you get the point. So right here, right now, it's pretty much indecision. And if you think that you're gonna be late to bottom tick, no, you will not be. And if you think you are a bit late to short maybe financials that were doing poor lately, yeah, you could be, because implied volatility is crazy if you are just net buyer, option buyer. But if you're who wants to sell and make money on a high implied volatility markets, well, there might be an opportunity. I'm not that type of a guy because I don't possess with like crazy amount of money to sell naked puts and just wait them to be worthless and pretty much have millions of collateral sitting in these stocks. But if that's your strategy, maybe even like credit spreads and stuff, yeah, maybe there's an opportunity. In today's heat map, I'm going to switch to today's heat map. You can see pretty much overall tech names held up just fine. Semiconductors held up some fine. Energy was the loser biggest, and of course financials. I mean, big financials, they're still getting hit. I mean, the biggest concern was Schwab, and that's this Thinkorswim platform is owned by Charles Schwab. TD Ameritrade and Charles Schwab merged. Basically, they bought the whole TD, and TD Ameritrade owns Thinkorswim. So that's why I was looking at like what's going on with this company. And I know like these are big. And back then when I was working when I had a 9 to 5, my retirement 401k was with Charles Schwab, and I looked up, they still have 7.6 trillion in customer assets. So one of those big to fail, but it dropped pretty big, and that's why I looked it up. And this was the only biggest like over $100 billion company that got pretty much dumped almost in a very short period of time, like 45%. So if you just measured this move, 3-day move alone, it was like all the way to $45 today's flush. It was 40% dump in like 3-4 days. That's pretty big dump, especially for a company that was like 130 billion or something like that. Currently, Charles Schwab is $94 billion company. But I think in terms of like day trading, maybe there might be an opportunity, but you got to be very careful. Also, SPX put to call ratio on Thursday and Friday was pretty big. Friday was the biggest jump since last June 13th. So that was the last time we saw people buy crazy puts and put to call ratio go higher. And today SPX, I just took a look at today's data, and if you look at the SPX put to call ratio, it's not too much. I mean, people looks like in a hurry they bought the puts on Friday, but still high. Put to call ratio 1.5 today for SPX. So oh my god, excuse me. So, and yeah, pretty much this is it. I don't want to talk too much. VIX, I think I wanted to cover about VIX. VIX is still high. When VIX is pretty high, I think it's a good opportunity to buy something, but it can go even higher. So that's why I'm basically in a waiting mode. Overnight short positions that I had in energy and some volatility UVXY names, I sold them in the morning. But I'm still expecting some sort of volatility after OPEX. But this week can stay volatile as well, as people will be still a little bit more emotional about all the news. But I suggest many of you just shut off the news and just do your own research. Just look at the charts and just maybe even turn off the YouTube maybe and do your research, focus on your trade. That's the best thing when market is going crazy, not to listen to anybody and just focus on your own ideas and trying to capitalize on your own ideas. So, but that's the video. Thanks for watching. See you in the next one.